Hi everyone. Should we get started?
Hi everyone. Sorry, Chai. I just wanted to tell you that today's meeting that we are conducting here is being recorded and is it's being live streamed on YouTube. So this is the first time that we are doing, and so I just want, before starting the meeting, I just wanted to tell that everyone will be on mute during the session of the meeting, and and if anybody have any question, we can just put it on the chat box that's there, and then we can discuss the questions at the end of the meeting. And so that's all I wanted to say before starting. And Chai, now you can take over and present for the on the topic, today's topic, that is Australian reporting season. Yeah. Thank you.
Oh, hello. Can you hear me? I can still hear the music in the background. Hello. Is that better for everyone? Hoping everyone's doing well during this period of coronavirus. Can you guys see my presentation up on the screen? There it is. Beautiful. Nice. So as Rashmi mentioned, and today we're discussing the Australian reporting season, providing a nice update. Really, it's really want to keep it open and casual. Please interrupt me if we have any questions whatsoever. I really just picked. There will be 4 investment managers from Banyan Tree that will be discussing various stocks. I really randomly picked the last 10 companies which reported, 10 companies which the investment managers of Banyan Tree sat in on the conference calls with the management teams of these companies. And really, we wanted just to highlight the key points to the results of these 10 companies, as well as what we think in terms of valuation, and what we think of in terms of a recommendation. Again, very informal. Wanted to keep it very open and casual. So really, I just wanted to start off with myself. Just a brief description of who I am. So my name is Tai Ung. I've spent the last 15 years of my life looking after various portfolios and have worked across been really fortunate in my career to have worked with Aberdeen Asset Management for 5 years as a portfolio manager, specifically looking after their small cap portfolio. Previous to that, I was an investment banker at Morgan Stanley for quite a number of years. I finished university with a Bachelor of Commerce and a Bachelor of Laws. I'm a qualified solicitor, but also, I have majors in pharmacology, so in the science area as well. So a bit of a nerd, to be honest. So the first stock that I really wanted to talk about was Telstra. Very interesting results. Obviously, Telstra is a really big company in Australia, and they reported recently very strong results. The 3 key things that I really thought about when I looked at the results, and having sat with management during the analyst briefing, was that the first one that what management said was they declared that the results were in line with guidance. but also they made a big declaration, and they've been doing it for the last few halves now, saying that this is their turning point in their financial trajectory, and where they see their next year in terms of earnings guidance was that underlying EBITDA should be about 7 to 7.3 billion, and that really represents high single digit growth, and that's really important to note, because as you know, for the longest time, Telstra has been, investors have been really critical of Telstra and their performance. The mobile business has been doing really well, but the legacy business in the fixed line business, as well as their separation of the NBN, has obviously not gone to plan in line with investor expectations. So that's a really nice outcome for their result, that they're returning to high single digit growth. And the second point that I would make is that on the conference call with the Telstra management team, they spoke a lot about how they're continuing to execute the T22 strategy, and they provide this really big table for investors to have a look at. And 80%, what we realize is that 80% of the scorecard they've already achieved, and so they're looking for really nice, also really nice cost reductions off the back of that, and they're on track to meet a target of 2.7 billion by next year. So a really great outcome. The third point is they've announced a on-market buyback of 1.35 billion, and that's just off the back of selling part of their towers business. It's the InfraCo sale. And that really should support the share price. Every time you see an on-market buyback, it means that the company has assessed a whole range of capital management initiatives. They've thought about paying out more dividends. They've thought about injecting that money towards project that they can undertake to deliver more growth for the investor. Or they simply can do a on-market buyback, thinking that that's the best means to improve shareholder returns. And the point there is also that that really underpins their share price. It means that the company is confident in what they're doing, such that they think that out of the range of capital management initiatives, they think that buying their own company is going to deliver the best returns for shareholders. Obviously, what this company has done in the past, we take with a grain of salt, but we upgraded the company to a buy recommendation because when we analyzed it, it really is on the precipice of something better than what they were previously. That table was essentially a table showing their valuations. These are consensus numbers, and on a 1 year basis, it doesn't look that attractive. 28.1 times. On a 2 year basis, 23.9 times, and on a 1 and 2 year basis, they're at roughly about 4% dividend yield. And you can see the share price performance there over the past year. It's really reflected in this reversion of their financial performance from yesteryear. They're up 29.8% over the last year. Again, off the lows of when the coronavirus happened, but at the same time, it's a good reversion for this company. The next company that has done phenomenally well and reported is Commonwealth Bank of Australia. Reported really strong results. Now, statutory profits in statutory NPAT of 8.8 billion is not what we're really focused on, but the cash, because when you analyze banks, we're more focused on cash NPAT, and of 8.6 billion, that's up 20% on FY20. And that's really off the improvement in economic conditions and outlook for lower loan impairment expense. Now, let me take you back a few notches. Recall back into when the coronavirus happened back in March 2020. When that happened, many companies were not sure what to do with their capital. A lot was still paying dividends. Now, what APRA said in June 2020 was that no, if you guys are increasing your provisions for non-performing loans, that means that you shouldn't be paying out more dividends, and we want you to hold more capital than necessary. So what the regulators then said was, we want you to hold. We don't want you to pay dividends more than 50% of your earnings. And so the major banks basically said, okay, that's fine. We won't do that. We'll follow your inverted commas guidance. And so the banks let the coronavirus play out. They went about their business. They increased the provisioning to cater for potential losses, in recognition of people not being able to pay because they're losing their jobs and whatnot. But really, come December 2020, APRA basically said, well, you guys are, Australia's managed the coronavirus quite well. We think that, you guys should be allowed to pay out dividends as you see fit now. And so, since January of this year, the banks pretty much reverted back to paying out normal dividend levels. Which is, again, a fantastic result. So in this result, CBA not only declared a final dividend of $2 per share, fully franked, that equated to a payout ratio of about 71%. Or if we normalize for long run loan loss rates, that equates to about 75%. But really, it's a great result considering, considering where we were at March 2020, when share prices were being impacted because the regulator was restricting their ability to pay dividends. The other really fantastic news from the result is the share buyback. The bank, again, like Telstra, went through a range of capital management considerations, and they thought that conducting a $6 billion buyback was the best way to return capital. And the interesting part of their share buyback is that it's an off-market buyback. The record date is actually today. So if you hold CBA shares, what you're able to do is that have CBA buy back your shares. Again, what will happen is that they'll have a buyback price. They're saying that it's roughly about 10 to 14% lower than the share price right now. And you would ask, why would an investor want to sell their shares at a 10 to 14% discount, or whatever the buyback price happens to be? Why would they do that? They can just sell it on the market. Well, the difference with this buyback as opposed to Telstra's buyback is that $21.66 is actually a fully franked dividend. So CBA is actually quite wise and smart. They've gone to the ATO and they basically asked for a tax ruling. And they've said, can you, whatever the share buyback price is, $21.66 is going to be a fully franked, considered a fully franked dividend. So really, for pensioners or with exposure to CBA, they're going to benefit from a tax perspective, obviously. So just looking at an example. So if the CBA buyback price was $100 and $21.66 is deemed as the capital component, then the $78 would be treated as a fully franked dividend. So again, that's really a lot of benefit for, particularly pension investors who are on a different. I shouldn't be giving tax advice here, but it's to their benefit, really. Just on an overall recommendation, though, we have CBA on a neutral. Now, the reason why we have it on a neutral is because if you look at a 1 year basis, it's done 46% in terms of performance. And if you look at a price to book basis, it's on a 2.4 times price to book. That relative to, if you look at this comparables table, if you look at the other banks, now CBA is really good, high quality bank. I don't doubt that whatsoever. And the loan book to the loan loss to the total gross loans is at a phenomenal shape. It's 20 basis points, I believe. So a lot of loans are being written and not a lot of losses. So it goes to it's a testament to their underwriting team. But yeah, valuations are fully pricing in for the quality of the company. Even if you look at the PE basis, 19.4 times. If you look at something like an ANZ, 13.3 times 1 year forward, 4.8% yield, so higher yield than CBA. But the price to book 1.3 times versus 2.4 times. So we're thinking that yes, CBA is a really great quality company, but a lot of that is already factored into the valuation. They'll still continue to do well, but we just don't think that it will do as well as previously. Let me introduce you to Max Riaz. Again, just for people in the call that don't know who Max Riaz is, Max is one of the investment managers and directors of our firm. Has over 20 years experience and has degrees in finance and engineering and honors in engineering at that. So a smart cookie. So let me put it over to Max to talk about two stocks of his interest there.
Hello, can you hear me? Hello, can everyone hear me? Hello? 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 Okay, sounds like everyone can hear me, but because I'm not getting any sound feedback from anyone, so it sounds a bit like I'm talking to myself, but as long as you can hear me, that's good. So I want to talk to you about, first and foremost, Goodman Group, a company that I've known for a number of years. Here we go. The latest, I'm a simple guy, right? So I like to get a bit of a backstory to the company and, what is it selling and where is it going? I'm not sure how many of you guys know about Goodman Group, but let's just start off. I'll give you the financials first, and then I'm going to give you a backstory on this stock. So the latest earnings results are very strong on this company. Earnings, EPS, have beat management's guidance. Next year's earnings guided to deliver 10% return growth or EPS growth in fiscal 21 on fiscal 21, and this is for a company that is a property owner and a property manager. And you think to yourself, well, hang on, apart from residential property, we don't know much of any other property groups or property, commercial property, i.e., retail as we know them traditionally, or office buildings or industrial buildings. he's a company that owns particularly industrial assets. It's delivering that kind of growth. Where's it coming from? So the backstory is that Goodman Group was floated on the market in 1995. It is run by all the way through a gentleman by the name of Greg Goodman, a very highly pedigreed individual. I believe his father was a very sort of pedigreed business owner out of New Zealand. Anyway, he came to Australia and set up his own business, and he wanted to put up, back in those days, in the 90s, what they would traditionally call sheds. So a warehousing shed, they used to call them. So he started off with assets under management of about a few mil only, with a staff of 8, and floated on the Australian Stock Exchange in 1995. The group I previously worked for helped with that float in this business. And really, it was not even a second-rate asset in those days to big, retail shopping centres like the Westfield was just getting up and going, and office buildings were sort of getting, asset of choice. But industrial buildings was really something off the backwater, from ownership point of view, in traditional REIT sort of sector. Anyway, roundabout, so the group continued to grow under Greg Goodman's sort of leadership into the 2000s, and did really well. Actually, the stock went from, from $1 or something to about $35, heading into the global financial crisis. And by that time, they had gone from just owning sheds to actually going out there and sourcing capital from people that wanted to invest in property and industrial property in particular. That's what their focus is, and develop those properties for them, and put a bit of their own equity in those properties and co-own those properties with them, and make a development margin. So the REIT, so there were a number of REITs in the 2000s, from 2004 onwards or thereabouts. They started to go, their models, business models, start to sort of transition from, just passive ownership of assets, in this case, industrial assets, to becoming more of a fund manager, development orientated income, that sort of they started to capture and get a lot of growth. So what happened was around the GFC of 2008, there was too much, as it was found out by a number of other major companies, including the REITs. There was a massive overhang of debt on their balance sheet, including Goodman Group. So, and it wasn't just a lot of debt that they had taken on their balance sheet to own property, but also to develop properties as well. And that was also short-term maturity. So there was a massive liquidity crunch as a result of the broader global financial crisis and the credit crunch that sort of came through that. So the stock actually went from $35 to, I want to get to where I'm getting to with this story. Is very important to understand. So the stock went from $35 to 15 cents in late 2008. And I sat across the table from Greg Goodman. We had holdings in their preference shares at the time, GMPPAs, and had some interest in the equity as well, but largely on their debt side, which was still protected. And really, this everyone thought that this company was going to go bust. Good assets, but balance sheet was completely almost insolvent. Anyway, they got the bailout from the Singaporean government, or the wealth fund, and the stock. So people just thought at the time, well, they will just survive, and really didn't pay attention to the stock. And if you look at the share price history from late 2008 or early 2009, the stock's gone from sub-dollar, or literally 15, 20 cents, to now, in its heady sort of numbers. So what's behind that is, I believe, a CEO who went a bit overboard with his strategy, but learned his lesson. He's got a skin in the game, and he's turned this business around to be the leading, along with Prologis globally, the leading industrial property group. It's not really, I wouldn't even call it industrial property group. It's actually playing the tailwind of people talk about e-commerce. So obviously, through this pandemic and in recent 18 months or so, there's been obviously a tailwind of a lot of retail happening online, right? So how these guys are benefiting from that increasing uptake of e-commerce, not just in Australia, obviously world over, some markets more than others, is that they are making their industrial properties, which have become really like lifestyle properties, but in industrial, they're big complexes. They've got warehouse and SPV smart offices attached to the big warehouse complexes. And they've got tenants like Amazons of the world, Deutsche Post, Australia Post, and they are bringing these assets as close to the end retail market as possible. So you would, if you're in Sydney, you would find their properties in, next to the major infrastructure, M7 or M5 or the airport or that type of thing. So what that does is they're working on the supply chain, bringing it down alongside with the Amazons of the world that they call clients, so that order fulfillment, when you click online as a customer of e-commerce, you're able to get your order through the routing of the warehouse pretty much that same day or next day. So that is the tailwind that they've been playing really heavily and doing really well at, and they're a global player. So much of their asset base is in Australia, about 20 odd bill. There's another collective 20 odd bill in Asia, across Japan and China. They've got assets in China. They've got big e-commerce companies like JD.com out of China that they call client, and alongside obviously Europe and the rest of the book out of Europe and North America and South America. So what I'm saying is that I actually see that tailwind to continue for this group off the back of obviously the e-commerce conversion of retail from traditional bricks and mortar retail to e-commerce. But I also see a company that is led by not just your arm's length CEO who's got a professional job, but someone who's actually covers the business, who's been through this story for the longest time. I know the CFO there as well, Mick Rondas, who's been there for the past 12 years. And I think there is enough of the culture that Greg has fostered at the top echelon of this company to continue executing this strategy of growth for this business into the years ahead. Even I think beyond Greg's own sort of years at the helm. So I'm pretty positive. Market's obviously seeing the results as positive off the back of that thematic. And look, the dividend yield on this stock is about 2%, but it's not the stock that you would buy for dividend yield. It's not passive. I mean, the 40, 50, 60% of the earnings actually come from development and asset management, and not just collecting retail, the rent on the industrial property. So that continues to grow. There's a huge pipeline of future orders from tenants wanting more space and expanding on space as their business grows off the back of e-commerce. So I think that tailwind will continue to grow for Goodman. And the valuation numbers you guys can see, we've got a target price of about $25 on it. The current price is around $22. So I think I think there's good forward sort of risk-adjusted growth baked into this business, and its ability to execute on its strategy, its ability to learn from its lessons of the past, particularly around the balance sheet management. I think they're all ticks from my point of view. What could go wrong? What could go wrong is potentially e-commerce sort of trade starts to sort of unwind and slow down, and people revert back to the traditional retail bricks and mortar. I don't see that happening. I think the behaviors are now becoming very well entrenched for people to just click and go and collect or have the deliveries made to their premises. So I think that story is going to continue growing globally, and these guys are beneficiary of that. So that's my blurb on Goodman Group, and we're positive on this stock and hold it in our portfolios. In terms of the The next stock I wanted to talk to you about just briefly, I won't spend much time on this one, is Charter Hall Social Infrastructure REIT. They have traditionally got assets in earlier childcare. That has continued to do well throughout this pandemic. I just look around people around me with very young families. Despite the lockdown in Sydney at the moment, I do see parents taking their children to the childcare centres or early childcare centres, preschool, because you might think, oh well, hang on, people are staying home and parents are staying home. Maybe they can just look after their own children. It's not that simple. I mean, we all of us are working from home. We've got children. Understand that it does take pretty hands-on supervision. So there's lots to be said about a structured environment that the schooling or preschooling provides for children and their growth. So that thematic continues for this stock. It's done well in the latest reported solid result, alongside in accordance with the expectations of the market. Year on year, earnings have increased 13%. So again, a good pocket of REITs market or property market. That's sorry, I can hear someone. Property market that's doing well. That's got good thematic behind it. Now they're moving into another sort of a segment that they call social infrastructure, where sort of more of a medical healthcare orientated tenants. I think they've done a tenancy deal with Mater hospitals and but they're looking to provide Mater the office, sort of the headquarter facility, and other sort of office related facilities that they want to offer to more health and lifestyle and medical type of tenants. That's an area on a thematic basis doing well anyway, but from REIT sort of looking to capture that segment in terms of tenants. I think that's sort of working in its favor. So that there's just the sort of target price we've got at the moment of $3.80. It's a bit under that, but it's got a strong yield of about the return on equity is about 7.3%, 7.1%, which is pretty good. If you can get that in the current market where the long bond yields, which have traditionally been the benchmark to compare returns on property assets, there's a good margin there to be having ownership in this stock. The dividend yield forward is 4.7%, and it's covered by obviously good WALE and tenancy base. So we continue to like this story. So that's pretty much the two stocks that I wanted to cover. If you've got any questions, by all means, we'll pass it on to Zach.
Thank you so much, Max, for a very informative, about the two stocks. Yeah. And so now, is there any other? I mean, are we going to talk about other stocks?
Yeah, we've got a few other stocks which we'll punch through, and Zach will talk about them. So Zach, you guys may know he's got 12 years. It needs to be updated. It's 15 years experience in financial markets. He was previously, obviously, founding director at Banyan Tree, but prior to that, he was the industrials analyst at RBC Capital Markets, and prior to that, he spent 6 years at IWF Research, looking after equities and hybrids, and he's also done fairly senior stints at private family offices as well. So I'll pass it on to Zach to impart some of his knowledge.
Zach, can we?
Sorry, I think you unmuted myself, but it's Zach that needs to be unmuted.
Sorry about that. We're just unmuting Zach now.
Yeah, sorry. Thank you.
Yeah, hopefully you can hear me now.
Oh, yes, Zach. So sorry about that.
I'll give you a bit of rundown on two different. That's okay. I'll give you a rundown on two unique stocks, different end of the spectrum. My internet's playing a bit, but hopefully it all comes out clear. The first stock, if we can just go to the next slide, I believe is Megaport. That is obviously, this is a growth oriented company that we've been following for a while. And basically what Megaport does is it's a provider of software defined networking. It deploys hardware infrastructure in data centers around the world. And then it leases networking infrastructure like cross connections and metro fiber from telcos. And what it allows companies to do is, instead of signing up different agreements with different data center providers who tend to stick with their own data centers, it allows enterprises to talk between two different data centers. So it sits its software within these data centers, and it allows enterprises to talk within from different data centers from different companies. Now, what are the benefits? What are the benefits of that? So, I mean, the tailwind we all know, so I don't think I need to go. So everything's shifting to cloud. Enterprises are shifting from online or offline, their in-house systems, to data centers, where they're setting up all their cloud computing and infrastructure within data centers, and obviously shifting their records online and their businesses online. So, it talks to the e-commerce that Max spoke about earlier. And then obviously, as companies grow, especially the large global companies, they have different, different setups and different offices around the world. They want to be closest to their data center for connection purposes and for for economics purposes. So, and that means having someone like Megaport competing, sorry, I think I dropped out there. I'm assuming everyone can hear me again. Apologies for that. So yeah, just on Megaport, allows obviously allows the companies, different enterprises, to be independent of different data centers, and instead of using independent data center, they use Megaport's infrastructure and software. Now, one of the key benefits, actually signing up with Megaport is also the ease with which you can sign up and get up and running. It takes a matter of days, in fact, hours in some instances. You go to a data center, there's big, heavy, convoluted contracts and whatnot that need to go through, and so the ease with which companies and clients can sign up is another big added benefit. So this is a company that's all about growth. So what we're really looking from this company is top line growth. It's EBITDA positive in some of its mature markets, but we're not worried about that right now. What we're really worried about is that 20-30%, even 30-40% growth per annum. That's what we want, because margins can come into play once they have established a market leading position, and they already have a market leading position. So that allows them to add additional services. That's additional revenue. and you know, and allows them to also do add-on acquisitions. So one of the acquisitions they've recently made is, again, just acquiring additional services, additional capabilities, which they don't need to build inside, and that continues that top line growth. So this is a company that we really like from a structural tailwind, from a cloud perspective, but also within that data center, I guess, area where a lot of people are playing that whole cloud computing through data centers, and I think this is another way of playing that. So we've got a valuation of $19. I think they're about to.
Hello.
Sorry, I can't hear.
I can hear you. Can you hear me, Zach?
I'm just assuming. Yeah, I can hear you.
Yeah. Okay. I wanted to ask you about who's the closest.
I can hear you.
Yeah, I was just wanted to ask you about who's the closest competitor to Megaport that we've liked in the past.
Well, there's no real closest competitor because it's a new company. It was only founded, I think, in 2012 and listed on 2016. It has got competitors in the US. The name escapes me, but the number of data centers that Megaport is represented in around the world is significantly ahead of some of those other guys. So it's actually quite a unique position in terms of competition. So it's not really compared to it's kind of, people say it's compared to data centers, but data centers can't really kick someone like Megaport out because it has a very strong market position. So it will be disrupting, the data centers will be disrupting a lot of the enterprises that already use it. And then at the same time, the telcos that provide some of the other infrastructure and hardware, well, it's not really their business as well. So it kind of sits very uniquely in between all these big organizations. And also Megaport connects enterprises to the likes of Google Cloud, AWS. So data centers can't really kick them out because a lot of the cloud providers are getting additional business. So yeah, it's from a clear-cut competitor perspective. I think there's one in the US, and I think Megaport has about 700 plus odd presence in different data centers, and I think the other one competitor has about 300-400. So a significant position, and that's the position I'm talking about when we talk about continue to reinvest that top line growth into new services and additional market share. Megaport. The other one is completely on the other end of the spectrum. It's AGL Energy. Very, very, very interestingly, AGL Energy.
Sorry.
This is the one that we look at.
Zach,
we look at
Horizon.
constantly.
Right.
We've covered it for a long time. It's a pretty complex
Horizon.
the way it does its electricity.
Sorry, Zach, it's Horizon.
Oh, Horizon. Okay, I thought we were going to do AGL. Horizon.
You can talk about AGL if you want, but we
yep. Sorry.
Yeah.
So Horizon. Yeah. So.
Yes, Zach, you're cutting off.
Yeah, Zach.
Zach, maybe I can just.
Sorry. Yeah, sorry about that. So it's quite interesting.
Maybe I can take it from here. I know that there's been a few line connection problems, but
Yep.
I
Shai.
spoke to Zach about it earlier when we were preparing for the presentation. But essentially, his thoughts were that they're in a really fantastic capital position, but they didn't really announce any further capital management initiatives, despite having about 900 million headroom on the balance sheet. The results itself was largely in line with our estimates and in line with consensus estimates. But we had to downgrade this to neutral from a buy. Valuations and yield are very attractive, but Zach said that he was worried about the FY22 earnings numbers. Guidance for him in terms of earnings coming from the having sat with the company's management team, really underwhelmed and was below Zach's expectations. I think he previously had 3% FY22 EBIT growth, but yeah, it really underwhelmed his expectations. The stock is really trading at 14.5 times 1 year forward, and again, a really solid 6.9% yield. But if you look at the performance, it's probably part of what he was talking about, that, despite valuations and a really solid yield, if you look at the 1 year numbers, it's done 11.1% underperformance. And really that's off the back of the FY22 numbers. People were expecting it not to do really well, but also secondly, there's this big shift in the institutional, particularly with institutional fund managers who are really exiting from, inverted commas, dirty companies. And obviously we all know that Horizon transports coal, and yeah, so it's a really interesting one that a lot of people have been looking at it very closely for the dividend yield mainly, but yeah, the performance seems to be underwhelming as its FY22. Now let me move on to the next presenter, Gaurav Singhla. Gaurav was, unfortunately, he just sent me a message. He was going to present, but again, he's had internet line problems connecting to this presentation. Again, I sat with him. Gaurav, just by way of background, has roughly 10 years experience, an accounting by background, and he's close to finishing, if not finished, his CFA. Really valuable investment manager on the team. I believe he picked QBE Insurance. Now, I personally have been following it as well because it's been an interesting one, particularly at the management level. I mean, on a side note, hopefully this is off the record, but it's a really interesting one because the last two CEOs have had to resign because they haven't declared they've had. Oh well, the last one unfortunately had a complaint by a female employee, and the previous one I think left but had a $500,000 pay reduction because he didn't declare that he had a personal private relationship with a fellow female colleague. So it's a really interesting one when we sit across the room and we have a chat with these management folks who are with all that, not non-operational but private business, private things happening. Look, operationally, QBE has been quite volatile. And to say that QBE has been volatile is an understatement because it has been. But in this last half-year result, they've seen premium increases. It's rebounded quite well. They've seen the expense ratio improve by 60 basis points, and it's declined to 13.7%. Balance sheet and capital position remains quite strong, and the board were able to declare 11 cents per share interim dividend, which is a really significant increase. Combined operating ratio was pretty good as well on that front. And I think the key point to what Gaurav was saying for this stock is that he left it on a neutral recommendation after meeting with the management team and after financially modeling the stock, simply because a big bulk of their earnings, the nice kicker for this company is that they've got investment returns coming from the fixed income, the shareholder from the shareholder funds. Just by way of explanation, when a lot of insurance companies, what they do is when they write out policies, they really have to keep some capital in the event of that client or that customer making a claim on that policy. So really what they do when but what they are able to do with that capital is take that and make some investments. Typically the regulators like them to have it in fixed income because it's more deemed as defensive as opposed to equities. So having said that, what Gaurav was saying, that when you model the shareholder returns within the shareholder funds that is kept as in the defensive fixed income portion, is that you don't get much return in this environment. And that's fair enough, and that's what he was saying when he was financially modeling the price, the intrinsic value of this business. He was not seeing much upside. So just by way of this slide, QBE is trading on 15.2 times 1 year forward, a nice 3.4% dividend yield. It's done really well in the last 6 months, seeing 41.6% uplift in the share price. But again, going forward, what Gaurav was saying is that the nice kicker in terms of returns from investment returns, he's not factoring much of that within his price target because he doesn't see the environment improving for these guys. The next stock that he wanted to talk about, which, when I spoke to him about, was Computershare. Really, the business struggled. It's somewhat a very difficult business to financially model. In terms of the FY21 results, they saw EPS decline of 7.3%. And that's really off the back of low interest rate environment. Again, the way that we model Computershare internally is it's one of the hardest businesses to model because their business model flips and flops from charging customers based off the interest rate. So say, for instance, if, hypothetically, there is a IPO that's coming onto the market, and a large one at that, in to the billions, like Facebook, for instance, 100 billion. They might not, to win that business, they would tender for it, but they might not charge a fixed rate to Facebook, but they will be able to. What they say to Facebook is that we'll take that 100 billion and let us bank it into the bank so that we can earn interest off that sum. And so with rates where they are in this low rate interest rate environment, you're not earning that much if they're using that revenue model. So these guys might be dishing out contracts for new IPOs in the sense of making those contracts based off fixed payment instead. The other parts of their business is mortgage service. The other parts of their business is share registries and whatnot, and maintaining that. And it's done quite well if you look at the headline numbers, but again on the EPS line, it declined 7%. although that was better than management's guidance of an 8% decline. Still paying good dividends, 23 cents for the final dividend, 60% fully franked, 6% franked, and that equates to about 67%. If you look at where we are in terms of forward PE, really a lot of the PE numbers and the valuation has factored into the quality of the business. 2.8% dividend yield. It's a solid business, but it really is this next leg of growth, which we don't see at the current environment. Last two stocks, back onto me. Had a bit of a look at Suncorp. Fantastic result. Really off the back of repricing, premium repricings and uplift in Australian business, but that was offset by the New Zealand business. And the New Zealand business has seen increased hazard costs. But overall, cash earnings of about $1,064 million, 1,064 million was up 42%. So really, really solid result. The interesting part, which is most important for shareholders, is a fully franked 8-cent special dividend that was paid, and an on-market share buyback of up to 250 million. So back to my comments on Telstra and CBA, and and last week on Rio, and even before that on Medcash, what we're seeing is a lot of on-market share buybacks coming through. In Suncorp's case, 250 million. And that really, again, should really support its share price. Again, that says to me, out of the range of capital management initiatives, they think that buying back their own shares is the best option. What it means, I mean, if you look at the forward PE here, 7.5 times 1 year forward, 4.7% dividend yield. On the multiples alone, in terms of forward PE, I wouldn't say that I would put this on a buy recommendation. But when you model this company financially, where it's trading at $12.33 relative to the intrinsic value of what we've modeled it at $14.10, we think it's got some risk to the upside. It's got sorry, not risk to upside. It's got nice upside and ways to go. So that's that with Suncorp. Charter Hall Longwell REIT, another one that I sat across the management team with during the results. Very, very boring company, and that's not a bad thing. That said, with a lot of love, it's a boring company, and but boring is very good, because the results were in line with their own guidance. And actually, it's a testament to the management team. For multiple halves since its IPO, it's just performed in line with what the management team have said. Now, it's really easy to say that because they've got a solid portfolio. They've got a solid portfolio with strong property fundamentals, a long WALE of 13.2 years. Slightly down from 14 years, but we're talking about, the marginals here. Like it's up 13, it's still at 13 years. Rental growth is a boring year-on-year 2 to 3%. Portfolio cap rate declined and firmed at 60 and were lower by 65 basis points. But again, 48% or half of their portfolio is on triple net leases, which basically means that the tenant pays for maintenance, capex, and all the outgoings, which is not very typical of leases that we see for other REITs. The other point that I wanted to make is that, when you sat across them during the analyst briefing, they confirmed a solid FY22 EPS number. Really no surprises at that, but they're talking about 6.4% uplift in EPS. Very boring company. We have it on a buy. It'll give you that nice 6% dividend yield. And it was just, it will just perform. It'll just give you that. It's a really nice dividend play. That was the end of the presentation. So I just wanted to push it across to you guys and, answer a few questions or hear a few comments. Let us know what you're thinking about if you would like to make any comments about any particular stocks or any stocks that are due to report or have already reported, or any questions from today's presentation. So over to you guys.
Thank you so much, Chai. Does anybody have any question?
We can also take it offline. The majority of you guys know who we are, and you have my phone numbers and my emails. I'm happy to, one thing that I wanted to say is that all these stocks that we've spoken about, there's a lot of details in the individual stock reports. So happy to talk anybody through the recommendations, the basics of the company, or our investment thesis of the company, or even our valuation and financial modeling of the company.
Vijay, would you like to? Vijay, we can't hear you, sorry. Vijay, sorry, we still can't hear you.
So sorry, Shai.
Yeah,
the team is
fine,
learning. They practiced well, but I think the performance on the day is just not happening. I'm very sorry. I'm very, very sorry for the bad and not good coordination with the team.
No, it's fine. I thought it went actually quite well. It's a large forum. It's a lot of people. I mean, there's also a lot of materials which we've sent to Shruti and Pooja. There's about 10 stock reports with a lot of financial data and analysis there. And the presentation is available to you. So, we can take it offline. We can talk a lot about these individual numbers. I know that, in this forum, we have 1 hour to talk about 10 stocks. So, some of the guys here, like, if we didn't shut them up, they can talk a lot.
Yes, thank you so much, Chai. We'll definitely, if like you said, we have all the information that you've already provided. So if we have any further questions, we'll get back to you offline.
Fantastic. Thanks for having us, Rajmi.
Thank you. And thank you, Max and Zach.
Thank you. Thank you, guys.
It was a very informative session today, so it was nice.
Thank you. Thank you.
Gaurav has also messaged me, so he's also available.
Yes.
Thanks, guys. Have a really great week, and
thank you.
I'll see you this time next week.
Yes, thank you so much. Have a lovely day.
Thanks, Chai. Thank you all. Thank you. Goodbye.
Thanks, Vijay. See you.
Thank you.
Thank you, everyone.
Recording